Hi, welcome back. We at BitWise understand it was a very hard time in the last 2 weeks with the fiasco of the FTX collapse. If you haven't watched our last video, we highly recommend you do so, you will feel much better afterward. In this episode, we will learn some lessons. Before we start, kindly support us by subscribing, liking, and sharing, thank you. After a challenging year for digital assets, many investors were blindsided by the recent collapse of cryptocurrency exchange FTX, as customers waited for answers about an estimated $1 billion to $2 billion of missing funds. While the future of the company, and investigations into the vanishing assets, are in limbo as FTX enters bankruptcy protection, experts say there are key lessons for crypto investors. The FTX collapse provides harsh reminders that there is no such thing as a free lunch when trying to make a quick buck in a still fairly new, unregulated financial industry. You should invest what you are willing to lose 100%, like in Vegas, and discretion and skepticism. Here are 4 other lessons for investors from FTX's downfall. The collapse of FTX will be good for traditional finance companies like Fidelity, who are entering the crypto space because they come with a certain level of trust. Earlier this month, Fidelity Investments announced plans to launch a commission-free crypto product, allowing investors to buy and sell Bitcoin and Ether. The FTX collapse has also renewed interest in cold storage via hardware wallet, taking digital currency offline, making it less susceptible to hacks. However, the move makes assets less liquid and more challenging to trade quickly. Diversification is always important. Experts say a large percentage of a single holding can be risky whether you're investing in stocks, cryptocurrency, or other assets. For individuals who had a very high allocation to cryptocurrencies, whether in FTX or not, the crypto price crashes this year were a painful lesson in the importance of diversifying one's investment classes. The FTX collapse should be a lesson that any individual company, be it a crypto exchange or a more traditional business, can go bankrupt in times of distress. Even if a financial asset is speculative in nature, it can still play a role in a well-diversified portfolio. Expect more crypto regulation. There's been an ongoing debate about how cryptocurrency should be classified and regulated, which has intensified amid the FTX fallout. In June, a bill was introduced to create a regulatory structure for digital currency, defining most assets as commodities, such as gold or oil, overseen by the Commodity Futures Trading Commission. Experts say the FTX meltdown may accelerate these discussions, and speed up the timeline for future guidelines, and these bad business models will go away. We discussed that in our last episode. A bipartisan hearing will be held in next month to investigate FTX's collapse. While Congress will ultimately decide how government agencies may regulate cryptocurrency, Securities and Exchange Commission Chair Gary Gensler has been pushing for tighter rules. Investors need better protection in the crypto space. Things need to change, and we need to think of a new path forward. New industry standards may emerge from this failure based on the Decentralization Index to measure the decentralization of exchange, DeFi best practices, smart contract security standards, ethical functionality, and proof of reserve standards, to name a few important ones here. Not your keys, not your coins is a popular expression in the world of cryptocurrencies. Without owning your keys, you wouldn't be in control of your coins. Curious as to why? Similar to a bank account number, cryptocurrencies are sent to a receiving address. The technical term for this address is the public key. When someone sends you some Bitcoin, they will send it to your public key. It's called public since you can send it to anyone without compromising your crypto. There is, however, another key that is linked to your public key. That would be the private key or seed phrase. This key is absolutely vital. Anyone with access to the private key can access the funds on the public key linked to In simpler terms, a private key is similar to a password or ATM PIN, a means of identifying you as the true owner. The difference between accessing and owning your coins. When logging into your favorite crypto exchange, it might seem like you actually own the coins on your account. After all, you do need to log in to gain access to them, right? Wrong. It looks like you're in total control of your assets, until you try to withdraw more cryptocurrencies than the platform permits, or lower than a certain threshold. As a matter of fact, the exchange might take a cut of any cryptocurrency transaction you make. They can quite simply do this since you don't own the private keys to the crypto assets on your account, they have them. This phenomenon isn't limited to exchanges, it goes for any wallet provider that doesn't allow you to own the keys to the associated funds. If you don't own the private keys, you are not the true owner of the funds, you'd be entrusting a third party to it. This means that they can essentially do whatever they want with the cryptocurrencies on your account. Why does owning my keys matter? There's a plethora of reasons why you'd want to own your keys rather than leave it in the custody of a third party, requiring you to trust your funds to them. This is what happened to FTX, their customers were unable to withdraw their assets. This scenario applies to all centralized exchanges and service entities. Satoshi's vision in Bitcoin white paper emphasizes the concept of decentralized, with no central server or trusted parties. Everything is based on cryptographic proof instead of trust. We at BitWise highly recommend our fans learn how to use a hardware wallet. Yes, it may take a bit of time to learn, different brands have slightly different ways of using, but in no time, it becomes a habit, just like using your smartphone. If you can use one, you can use a hard wallet. All brands have step-by-step tutorials. Just take note, never buy a used hardware wallet, always get direct from brands or their local authorized distributors. I will be leaving some information below, hope you like today's